When I read about venture capitalists, your next good investment idea often comes from something that's going wrong with your other idea. You're on the board of your old company, and then you figure out they're hitting some bottleneck, and then another startup happens, which is going to solve that bottleneck. So one idea leads to the next. Is there something similar in your business?
Yes. When I think of our growth, could we have been better or done something better? And then, gee, this didn't seem to work how we thought it would work. So I'll give kind of two examples of that. In emerging markets, we appreciated that we were a tourist, and we would usually buy on-the-run securities, and we would trade, and it would work. We would tend to focus on corporate debt. So we decided that this was an area we wanted to get broader and deeper. And to take a step back, even from the inception of the firm, the idea was if we were broader and deeper and had more ideas than we had assets, we'd be able to grow, and you could see, and the performance would be seamless. So emerging markets seemed like a logical place to do that. So we want to expand in emerging markets, and we're doing corporate debt. And we find out pretty quickly we're focusing on the wrong area. The larger part of the market isn't corporate debt, it's sovereign debt, quasi-sovereign debt, and currency derivative. Our currency products, local product, local debt. So that's what we focused on. And you look at something like Argentina, we did a fund which wrapped up after 4 years. And if you took the on-the-run name, that would have had the base sovereign piece of debt, call it the 7-year at the time, would have had returns of 1.25. We were able to have returns of 1.75, and it's a fully realized fund because we were able to choose what we thought were taking the same risk, better expressions, better upside, lower downside, and so that would be one way that's worked. The other way would be in the M&A side, where being a distressed manager, and particularly having more situations where we're the controlling shareholder, is we found that what we thought something was worth turned out to not be what it was worth. And we're like, well, why is that? So the obvious answer is, gee, the advisors were atrocious. It couldn't possibly be the way we approached it. It was the advisor's fault. So we thought, that is, I thought that a couple of times, and then we said, you know what, maybe there's a reason why there's this M&A industry, and maybe we could do this better.